Hey everybody, welcome back to another episode of Cash Flow with JVH. Today we're actually going to be answering a few of the questions that you've posted on my YouTube channel and some of the videos. Figure it's probably a little bit easier to answer them in a video post than necessarily replying to all of them. I appreciate everybody's engagement and contributions to the channel. Everybody has been posting some really great appreciation comments as well. Some questions that have come up regarding some of my methods and some of my strategies. So we're hoping to address some of them today on this video. Just a reminder, if you do like these videos, give me a thumbs up and make sure that you subscribe to this channel. Be sure to share my channel and videos out across your social media sites and get me some more visibility. If you could, take a look at the description below this video and take a look at some of the ways you can help support the channel, in that I also provide my Robinhood referral account link as well as my Venmo information. I first want to give a big shout out to all of my subscribers, all of the people that have supported this channel, and everyone that has watched my videos and commented on them, good or bad. I appreciate everybody's engagement. I have just reached over 260 subscribers, which I never expected to reach that many people. I really just kind of started this to put my opinions out there and also help educate some people as well if they are getting into trading and things like Robinhood early. I'm hoping that I can provide some value in some of these videos, but I did not expect to have this much of an outpouring and this much support. So again, thank you everybody for all of your support. I really do appreciate it. So the first comment I'm going to take comes from Love Thy Country. And Love Thy Country says, you're leaving out volatility consideration. Also, 80 is pretty far out of the money. It's picking up nickels in front of a steamroller. So this is in reference to my video around safe way to trading options utilizing the put credit spread strategy that I put forth. So the first thing I'm going to say is I am not a financial advisor. I provide basically my advice on the strategies that I execute. I do not make any kind of guarantees that things will work out, right? There are no guarantees in life other than death and taxes. I do want to make the statement, or I want to address Love Thy Country. You mentioned volatility considerations. Absolutely. So as part, I may not have mentioned that directly in the put credit spread video, but I have a series of videos that talks about options where I do address volatility consideration. And you are right, it is definitely something to consider, and it is different for each option that you would buy or sell. So please, put that into your consideration or your risk profile as you are looking to execute on these strategies. 80 is pretty far out of the money. I don't necessarily know that I would consider picking up nickels in front of a steamroller. Having a delta of about 80 is, especially when it comes to the put credit spread strategy, is a good way to keep it as safe as possible. Again, I am very risk averse. Other people may not be. They may be willing to pick up a larger premium and credit with the put credit spread and have less of a chance of success and be okay with managing the higher level of risk. Personally, I am not. I like to keep things very safe. So again, it's just one strategy that I looked and that I execute on, and I keep it extremely safe, but it's not for everybody. So the next comment comes from a Dennis Ackerman. And Dennis says, I think for sure DIA, the stock symbol DIA, has to be one of the more stagnant ETFs to safely run spreads against. So somebody else had also made the suggestion, and I apologize, I forget who it was that made the suggestion, but when I had talked about the put credit spread, I had mentioned a few that I execute on as far as SPY, Triple Q, and IWM. Somebody had made the suggestion to do it on DIA. I have done a few put credit spreads on DIA, so again, I appreciate that suggestion. And I definitely concur with Dennis that it is very much a primarily flat, if not slow growth ETF, and it is a great way to run option or do a put credit spread on, because it is done weekly, and you can get, pretty good return depending on your level of what you consider a good return or your level of risk. Two comments from the same person, each on a different video. So I'll take the first one, which was on the put credit spread strategy video that I put out there. Comes from an L Butch J. It says, really like the way you explain spreads. Clear, simple. Thank you. I appreciate that. What about being exercised after hours? If you get out early, do you lose money? So I want to make sure that we're utilizing the terminology correctly. So when you say, what about being exercised after hours? Do you mean being assigned your short leg in that put credit strategy, or that put credit spread rather? So it is always a possibility. However, if you're using a platform like Robinhood, once the markets close at 4 o'clock, technically the exchanges do have the option to put in orders up until 5 o'clock on a Friday, which is typically the day of expiration. However, if you are pretty far out of the money still, it's very low chance that you will be assigned that short leg. If you are assigned that short leg, that's the reason that you bought the long leg as part of this put credit spread strategy. So that if you are assigned, then Robinhood or whoever your broker is most likely will execute the long leg, so that you can cut your losses, and you would only be responsible for the difference between your short leg and your long leg, minus the credit that you had already previously received. He also asks, if you get out early, do you lose money? So my recommendation, if you are doing a weekly put credit spread, I highly recommend opening your position on Monday and then closing your position once you reach 50% of that premium, and then try to close it, or wait until Thursday. I do not recommend waiting until Friday, because there's a lot of volatility in the market on Fridays. People doing a lot of selling, people doing a lot of buying. It could really jeopardize the put credit spreads that you have open. So I recommend trying to close out those positions on Thursday. Now, sometimes you may be in a negative because the stock didn't go up or it went down significantly. You have to wait till Friday to try to get as much of that premium back. I understand that, but from a general perspective, I try to open on Monday, close on Thursday, and if at some point it reaches 50% of my premium, I'm happy with a 50% return. Others may not be. I'm happy with that, so I will try to close it out when it gets to 50%. L Butch J had another comment on my poor man's covered call video. They say, in your example, I do not see where we are making money. Did we pay in the long leg? How many times do we sell to make money? So this is a great question, right? And I apologize if I didn't go into as many details to really make this crystal clear. So let me try to do that now. When you purchase your long leg, again, you want to make sure that this is as far out, like 3 or more months out, so that you have enough time to sell calls, weekly calls preferably, against that long leg to make up the money that you paid in premium for that long leg. So the idea here is, when you choose your long leg, or you choose your underlying stock to execute this poor man's covered call strategy against, you want to try to find a stock that you believe you are bullish on, that it's going to go up. Because the idea here is, you want it to at least get to that break-even point of your long leg by the time of expiration, so that you're not losing the premium that you spent on that long leg. Selling the short legs each week or every other week, whatever your strategy is or your preference is, selling the short legs is really just trying to protect that investment you made in the long leg, in the chance that it doesn't go up, the underlying stock doesn't go up, or it potentially goes down. And you want to try to make up some of that premium that you would put out there. So the idea is, yes, you are going to pay a premium for that long leg, but the idea is you want to make sure that you're going to protect that investment by selling the short legs. Now, again, if you're really good and you do the research and you're good at predicting things, you can. The best way to do this is buy your long leg when the stock is down, so you're paying less in premium for that long leg. And then as the stock goes up, utilize your charts, utilize your stock indicators to try to determine, maybe if it gets to that first level or second level ceiling, where maybe then you try to sell a short leg, because it'll be the highest, generally speaking, it'll be the highest price of premium that you will collect in the chance that the stock goes back down. Or maybe you wait until it goes up and starts to come down a little bit, then you sell your short leg just in case it keeps going down, protect that long leg investment. So I hope I answered that question for you, L. Butch J. All right, our next question comes from HGT, and they are asking, are option sales counted as ordinary income? I'm assuming you are asking from a tax perspective. I do want to state I am not a tax expert. I am not an accountant. I am not a tax accountant. I am not going to offer any tax or accounting advice for this. However, I will state any profit that you make on your options trades or your stock trades, any profit you make is considered a capital gain. Now, I will let you talk to your accountant or tax advisor on what that means for you specifically from a tax implication, but it is considered a capital gain and it is considered income. Our next question comes from Jonathan B, and they ask, is collateral how much you spend? So this is in regards to the put credit spread video that I put out, and when I had mentioned that you sell a strike and then, sell a put at a strike price just above the strike price of the put you buy, right? So in the example, I used the $1 difference, which equates to $100. That $100 is your collateral, and collateral is not what you're spending; it's what gets held by your brokerage organization. So for Robinhood, if you sell a strike at $100 sell a strike at $2, buy a strike at $1, that's a $1 difference times 100 shares is $100. That is your collateral that Robinhood will hold from your account until that trade or that option expires, or you go to close out your position. That is also the collateral that if for some reason you are assigned, in this case with the put credit spread, if you are assigned that short leg of the put credit spread, then they will automatically close out your long leg, the put that you bought, to fulfill that put that you sold. You will lose that $100 in collateral, but you will have already gained the credit from that put credit spread. So if your credit was $10, you lose the $100 in collateral, but you've already gained the $10, so your net loss is only $90. So the next question comes from JKane92, and they ask, in your example of selling a $363 put and buying a $362 put, what happens if the price ends in between those values? So for example, $262.50. Your 363 would be exercised, meaning you have to buy 100 shares, but the 362 would be out of the money and expire worthless. Am I missing something here? So a couple things. The only way that you would be assigned is if the stock price falls below the short leg, which is the put that you sold. If it falls below that short put's break-even point. And again, on Robinhood, it shows you the break-even point of those legs. But if that happens, your long leg would also be exercised and used as the 100 shares to fill the put that you sold. So again, the max loss would be the difference between the strike prices minus the credit that you initially received as part of the put credit spread strategy. The next comment comes from Kenny. Kenny says, great video, thank you. Well, thank you, Kenny. I've been noticing I can make a decent living from just trading my stock options each month, but interested to see your portfolio value and some of your trades. Look forward to more videos. Currently seeing 15% each month, but 10% each week sounds much better. Appreciate the comment, Kenny. I'm really glad to see that you're doing well. 15% each month is a really great return. Again, it all depends on what your definition of good or great is. Also depends on your risk level as well. When I made this statement about potentially 10% each week, again, it all depends on your risk level. It all depends on what underlying stocks that you choose. It also depends on the distance between, like how much of a collateral that you are willing to put up, how much risk you're willing to put up, and based on the premium that you're going to collect, right? So again, 10% was just a figure that I threw out there, that it is possible, but again, depending on your level of risk, depending on the amount of money that you have to invest, and depends on what underlying stocks you're going to be invested in. But I'm really glad you're having a great return, Kenny, and wish you more success in the future. Next question comes, or next comment comes from Sugar. How come RH Robinhood decided to sell my spreads early? Great question. I've actually experienced this myself, and I didn't realize what it was doing either. But if you take a look at some of the terms and conditions that Robinhood puts on their website, they can explain that in more detail. But essentially, if they feel that you are getting close to being assigned to one of your options, right, and they consider it high risk that you might be assigned, they will try everything they can to close out your position, whether you're in a negative or a positive at that time. They will try to close that out to prevent any additional risk. Now again, if they do that, and then the actual option position changes in your changes for the better, right? So if you were down $100 and they decided to close it out because there was only 10 minutes left in the trading day, and all of a sudden, the stock price jumps up and your call that you bought is now, $10 in profit, or $10 in a return instead of a $100 loss. That's kind of the risk that you take, but Robinhood does reserve the right to try to close out those positions for you early. Again, it's just part of the agreement that you signed up with Robinhood. Robinhood, it's all in that end user agreement. Nobody like myself reads entirely, but I would go into Robinhood website, check out their help section, and check out the information they provide about closing out your positions early if they deem it's a high risk situation. Lastly, I want to address a comment that was given by Watch It Now. Watch It Now says, when somebody tells you they have a simple strategy but will teach you how to make 10% with options every week, guaranteed trading on Robinhood, don't walk, run. You will lose your shirt. Don't tell me I didn't warn you. Watch It Now, I really do appreciate the participation. I do like the fact that people are watching my videos and getting some value from it. I do want to address this in a couple ways. The first way is, again, I am not a financial advisor. I am not a full-time trader. I am not a broker. I have no affiliation with any brokerage houses. I am just a part-time person who does this on the side and is learning as much about trading options in the stock market as possible, and then sharing my experiences with you through YouTube, in the hopes that maybe you learn something that either I experienced and maybe found difficulty with, and had a poor experience with, and I'm trying to share those lessons learned with you so that hopefully you don't fall into those same traps. As far as the video that you commented on, the title, Safe Way to Trade Options on Robinhood and Make Income Every Week Through a Put Credit Spread. Again, I really did not make any guarantees. I don't make any guarantees in any of the strategies or any of the videos that I post. I also didn't say that it was a guaranteed 10% every week, right? That's just kind of a general figure that I put out there, so I apologize if people thought that I was offering a guarantee of 10% every single week. Again, as I explained earlier, it really depends on the underlying stock. It depends on your strategy. It depends on, multiple factors, but you could potentially earn up to 10% each week doing a put credit spread strategy. No guarantees, but it is once you learn all of the factors that are happening in a put credit spread strategy, it is a pretty simple strategy to execute on as long as you've done your research and you know the risks that are involved in executing a strategy like that, and you know how to manage those risks. So if you know all of those going into it, it is a pretty simple strategy to try to execute on. Again, understanding what all is involved and doing your research to make sure that you select an appropriate underlying stock option. So again, I appreciate the comments from everybody, and I enjoy the engagement that you're giving me on these videos. Again, really appreciate all the support. 260 plus subscribers is no easy task. It's no simple feat. I know there are YouTubers out there that have millions of subscribers, but again, I'm just a part-time person looking to understand more about the stock market and options trading, and then hopefully pass on some of that knowledge and insight and experience onto my viewers and supporters. So again, really appreciate everybody's time today. Hope you got something out of this video. Really appreciate all the comments, and hopefully I addressed some of the questions that were sent to me. I apologize I didn't get to everybody's comment and everybody's question. It really is kind of overwhelming, but in a good way, of how much engagement that I've received on these videos and in this channel. If you enjoyed this video, please give me a thumbs up. Help support the channel by looking at all the ways you can support it in the description below. And then also remember to subscribe and share this channel out with all of your friends and all your social media networks. Have a great day, and we'll see you next time.